Thank you, Vikram, and good morning, everybody, for joining the call today. Post the announcement of our Q3 FY21 results yesterday. The results have been posted on the website. I'm sure you all had a chance to look at them, and we'll spend some time on that today. Today I have with me Mr. P.V.S.N. Raju, the Chief Delivery Officer of the company, Mr. Jagannathan, the CFO of the company, Mr. Ranganath Puranik, the Chief Growth Officer, Mr. Sujit Mahanti, Head of India Business and Director on SITL, and Mr. Satyanarayana, the Head of Strategic Finance Function. So, as I said in our last call, I just mentioned that that we had gone out of the uncertainty and we are seeing a lot more clarity in our business, and said that we are looking forward to growth as we go forward. I'd also said that we had reversed back a lot of deficiencies on cost cutting, etc. We had done in that quarter, and which we have also implemented this quarter. So, as mentioned by me, I think the results speak for themselves. I think we have shown fairly secular growth in the international business across all our verticals. We have seen our profitability rise because of both in terms of utilization, change in the on-site offshore mix, and actually a better realization for the services we have provided. We have seen a steady growth in our digital business, continuing to show that our whole platformation concept is working. Incidentally, it's now 4 years since we have actually announced it and launched platformation as a concept. We have seen, as I said, growth across the various geographies in which we operate. So going forward, I think
the conference is now being recorded.
Continue to see this growth, got the visibility for that in terms of both our top line and profitability. We also announced a compensation revision across the board starting 1st of January 2021. But whatever growth we are talking about is factoring the compensation increases we are planning effective 1st of Jan. Our India business has shown tremendous growth. Actually, I think if we had a more or less a lifetime kind of
Sorry to interrupt, ladies and gentlemen. Please stay connected. We lost the line of Mr. Reddy. We're reconnecting him. Please stay connected. Ladies and gentlemen, we have the line back for Mr. Reddy. Sir, please go ahead. Thank you.
No, so what happened? They couldn't hear me?
No, we just lost your line in between. It was just about 10 seconds ago. You may please go ahead.
All right. Okay. I guess. Okay. So as I said, yeah, I mean, I think if I missed anything, I think people can ask me back questions. But as I said, our India business has shown tremendous growth and has had the highest, margins ever in terms of historically, in terms of absolute terms. And I said, so overall, I see that we are on track in terms of what we have set, a quarter back in terms of our growth. And we've also, I think, started adding back manpower, and we'll continue to do that fairly intensely as we go forward. and a big push on investments now across the board, whether it is sales and marketing and M&A and IT and everything else. So overall, I think we are poised for growth. We've used the opportunity to really create a very strong organization across the board and improve our processes and all that kind of thing. So that's in a nutshell from me. I'll be quite happy to take questions as we go forward. I'll hand it over to Jagan to take you through the more detailed analysis of the numbers.
Thank you, Shikhar. Good morning, all. I will now highlight financial performance in a little more details, both for international business as well as the domestic business. This shows the consolidated performance of the revenue. The revenue performance has been really good, particularly the EBITDA performance of the international business. And as Shikhar was highlighting, the gross contribution from VC from our India business has been one of the record highs in this quarter. Their revenue was also has grown very well. They've done a good performance. On the international services business, if you can see, our growth has been revenues quarterly growth for last 12 quarters have been consistently high, and this international EBITDA percentage has been growing faster than the revenue growth. We have a record EBITDA of 29% in this quarter. The PAT percentage mentioned here is after the VSC scheme. Without the VSC scheme, this percentage is somewhere around 19%, 18.7, 19% is the PAT percentage for this quarter, which has been one of the best performing quarters in terms of profitability for us, and also consistent with consistent revenue growth. Domestic business, as we mentioned earlier, domestic business needs to be measured on absolute gross contribution growth. The absolute gross contribution has been growing very steadily from 30 crores in last quarter to 38 crores. This is like 28% growth quarter on quarter, a record growth in terms of the gross contribution. Considering all the challenges in the economy, we have done a very good performance in this space also. Few more metrics on the financial summary. If there is any question, we have given what is the PAT before VSC and after VSC also has been highlighted. This is to say that this is a one-time settlement we have taken on this. After this, without this, our performance has been as same as March of 2020. We have reached to that level at absolute PAT level. This has been one of the best performing quarter for us. We are very, very confident of continuing our performance in the coming quarters. This is apart from this profitability, I also wanted to highlight to all of you that the cash generation has been really positive for us. We have very, very strong cash generation during this quarter. The free cash flow as a percentage of EBITDA has been really good. We have done an additional cash generation of almost 80 crores in both the businesses put together. Very, very strong profitability growth, very strong revenue growth, industry-beating revenue growth in dollar terms, and in very good performance on the gross contribution, absolute gross contribution from domestic, and also a strong cash generation during this quarter. Some operation metric, as Shikhar was mentioning, this US geography continue to be doing well. Their contribution in the overall revenue continue to remain at 50 and 52%. Europe has gone up in this quarter. We are bouncing back in Europe. We will expecting a strong trajectory in the coming quarters in Europe also. In terms of industry, by industry, if you see ISV revenue contribution is continuously going up. The travel vertical remains at the same. We have mentioned earlier also that it will remain at the same level as we had in Q2 of 2021. We will update later whenever we get update on this. Distribution, manufacturing, retail, essential is going up as a percentage. This has been a really good performance for us. This is a good this vertical has been showing a very, very strong signal. Apart from it, the commodity and service industry, we have highlighted in last quarter also, the service industry is bouncing back very strongly. So this is also doing well. In terms of competencies, if you see, our focus on ERP, cloud and data actually is helping us all our revenues in terms of Dynamics or in terms of other digital platforms or cloud managed cloud services have been growing very, very strongly. Apart from data analytics, that is also growing strongly. The offshore mix for this quarter has once again come down. This helped us to increase the profitability strongly, apart from the utilization and billability of this in this quarter. This has helped us to perform in a best of the scales in the industry. Few more of that, we have added 8 new clients in this period. Very strong performance for a quarter, and we believe that our headcount is also going up. Our headcount has been added by 100 plus people, particularly on the delivery side. We have also added the Ascendum headcount. This is an investment, as Srikhar was highlighting. We'll be investing more in the coming days. Very, very strong trajectory for people addition in the coming quarters. We are expecting strong performance in the coming quarters for Sonata as well. Now, with this, I complete my update. We will take up the questions in the coming time. Handing over back to for questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone phone now. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets for asking a question. We will wait for a moment while the question queue assembles. Ladies and gentlemen, to ask a question, please press star followed by 1 on your touchtone phone now. We have a first question from the line of Baidik Sarkar from Unifi Capital. Please go ahead.
Hi, good morning, Srikhar and Jagan, and congrats on the strong pullback in operations. The lead indicators from your top client, Microsoft, are significantly ahead of what you've reported as a vendor proxy. And at 32% of the business, my question is, how should we understand this lag in business? Are we missing some part of the growth? And given the rate at which Microsoft is committed to grow, how should we predict the rate of your growth here and in the services business overall?
Oh, I didn't understand your question. Baidik, you're saying the growth in the ISV is a proxy for our Microsoft account? Is that the question?
I'm assuming that, Srikhar. I'm assuming
okay, and the second question is that we are growing higher than Microsoft. Is that the second part of the question?
Well, unless I've gotten my numbers wrong, my second part of the question was, Microsoft's guidance in their, Dynamics and cloud business is significantly high double digits.
Got it.
Clearly isn't our numbers.
I should. Right. Again, I think I've mentioned it in the past, right? We have two motions with Microsoft. One is what we go to the market with Microsoft. That will reflect in our more or less other verticals, more or less. It will reflect in retail and distribution, commodity and service, and so forth. So second is what we do with Microsoft. So the ISV revenues, we report other revenues we get from Microsoft, and Microsoft-like accounts or services we provide to such companies where we provide platform or product building services, even if they are enterprises kind of stuff. Okay. So first is I'm saying, it's not 100% proxy of Microsoft's increased spend on partners kind of thing. So I wouldn't use that as a metric kind of thing. So, I would like to correct that stuff. So as Microsoft guidance is, I guess, across the sectors, right? I don't think they give specific guidance by business unit and business line. Anyway, the Dynamics business unit gets merged under a much larger business unit when they report their numbers, because it's still not like a significant number for them kind of stuff. So to answer the question, one is in the market, we are seeing a lot more now interest as companies are coming back. Companies that pulled back spends on investing in new platforms and so on and so forth. So we actually see more interest now. While they used the pandemic to invest on immediate stuff like cloud and teams and, which had to do with some immediate response to the pandemic and, how do you get things. So we saw a bump there. And this actually took a backseat because people said, let's wait and watch for the big ticket items. So now we are actually seeing more interest coming back from clients. That's on the market side. Other one is, I wouldn't use it as a proxy for just Microsoft as an account. So we are seeing basically secular growth across people who are wanting to invest in creating new platforms for themselves.
Thank you, Srikanth. That's comforting. The operating leverage through offshoring has moved very well over the last 5 quarters. Have we maxed out on that lever, or is there more to come? In other words, are these margins defendable, given your peak utilizations are well? Or should we...
there are some costs which will come back, right? Like travel and, office costs and all that. So I guess, we have to also factor in that while there are a lot of levers which have been operating, one is there is a general reduction on costs, which will come back sooner or later. So the second is at a high level, we can say that it has maxed out. Maybe there may be a little bit left, but because what we did was in this time was, because of whatever issues of travel and other things, we convinced clients that we can actually do it from here instead of coming on site. So as things change, some of those may revert back to saying, I think you can come here and work kind of thing. So to answer your question, maybe it may max out in a quarter, but after that it may go back to, and then the trend could change. The second is, as I said, there are costs which will come back, in terms of travel and office costs and so on and so forth.
Sure. And my last question, in H2 of last year, we had a non-operating provision from ILFS, and this year again, there's a prior period tax impact. What else should we brace for on the non-operating times?
Okay, I should get this out of the way. See, I think we took a very prudent decision on this tax because the government offered this scheme. We had these old things where we have won at every stage, which we have been telling all of you that we don't believe it's got absolutely any risk to the company. But then, we said if, I think net off, we could write off a contingent liability of more than 100 crores. We said, okay, if we spend 20 crores and write off 100 crore contingent liability, it looks like a prudent decision. We continue to insist that whatever we have talked about in the past in terms of the strength of our cases are absolutely, as I said, we have won at every stage. They're all in our favor. But we felt that the government has offered the scheme. Let's just take it rather than spend our time on litigation and so on and so forth. The cost benefit looked very attractive. So,
So the contingent bracket now on taxes is zero? Is that...
No, it's not zero. I'm saying there are things, but I'm saying we felt that it was a, how do you say, return versus, how much I pay kind of stuff. The rest of it we said, anyway, we have got good case. We don't need to worry about it kind of stuff. This we said that I think it's just possibly...
So is there anything else on the non-operating front that we need to worry about? Other investments?
Not at all.
I don't know.
Not at all. I think my feeling is we've absolutely taken we could have stayed this way. We did not have settled it. It wasn't that we had lost the case, we settled it, right? We have won all the cases. So I think I would actually ask all of you to say that it's absolutely a very prudent and, decision. We could have just not done it. Let's be very clear about it. Despite the advice from our consultant. But we actually said that, let's go and do this kind of stuff. So I think we have been ultra-conservative, if you want to call that way. But otherwise, I would assure you that there is nothing we need.
Sure. And just closing questions from my side. Your question on the momentum on TUI and the domestic product business. What's the gradient?
TUI, as I said, we'll wait and watch. I think now the second wave, third wave, vaccination, etc. We'll get a much better visibility in 3 months' time in April. Because while the value is about 1/3, I think the volume is about, 40% because of the movement to offshore. And I think by April timeframe, we'll see whether it stays at this level or there could be a reasonable bump to it once they are very clear about their business. And because right now still their bookings are not there. So once the booking starts, right now we are helping them with build for the future. So when the booking starts, we'll continue to go back to actually supporting their current business. Right now, that's not much.
And the domestic business?
Domestic, yeah. I mean, we'll continue to see the momentum. I think we've added, as I said, new product lines, Amazon, Google, some press releases we have made, system integration as a business unit, some managed services associated with it. So we see that continuing to, this quarter might be 25-30% growth on a quarter-on-quarter, maybe an aberration, but we'll continue to see absolutely steady growth in that business.
Thanks, Srikanth. My best wishes.
Yeah, thank you.
Thank you, sir. We have a next question from the line of Harit Shah from KRChoksey Shares and Securities. Please go ahead.
Yes, thank you for the opportunity. I just wanted to understand, your non-essential retail segment has been, for the last 4 quarters in a row now, it has been, revenue has been falling quite substantially. In fact, this quarter, I think it was down by more than 60% year on year. So what is the outlook out there? Any kind of, revival are you seeing? How is the outlook looking out there at the moment?
I think we have to wait for another couple of quarters because it's unlike travel. It's really buyer behavior, and nobody is clear how do consumers will behave. Travel is very clear. People say that once things come back, people will travel at least for leisure. It's not for business. But non-essential physical retail is something which people are still waiting and watching whether. Once they've got used to this thing, how much footfalls will come back, etc. So things have to stabilize. And before people open up their pockets and invest kind of stuff. So I would give it a couple of quarters at least.
Okay, so just as a clarification, typically what would you classify under, essential and non-essential retail?
Essential retail is like daily requirement goods, whether it is grocers, pharmacies, and I would also add, furniture, mattresses. Now with this pandemic, actually electronics has become essential and all that. Non-essential is luxury goods from cosmetics, jewelry, and leather bags and all that kind of stuff.
Okay, got that. Okay, secondly, your within your vertical breakup, if you see your others segment, has been tracking at the second largest vertical for quite some time now. So would you at some point be looking to possibly break that up a little bit further, because it's others it's larger than probably most of them would be larger than even
right.
Maybe non-essential retail, something like that. So some sort of a color on that.
I think so. See, I think we should actually. I think a lot of people actually report it as ISV, because what we do for these others is actually what we'll do for ISV, which we actually help them build platforms and stuff like that. So it's not a domain-based, domain-led business unit. So maybe we'll figure it out. And yeah, for your sake, I would possibly say that assuming it's an extension of our. A lot of other companies I know use these. Even if they do platform for a retail company, they use it as a ISV, product engineering service kind of stuff. So it's not a domain-led. So that's why we are not breaking it up. We are not going to somebody and saying, I know insurance very well, so give me business kind of stuff. It's really, I know technology very well, give me business.
Right. So this is probably more a horizontal based kind of a thing.
Horizontal based, yeah. So it's like really a service you provide to a ISV. A platform building and that kind of stuff, and less of. I know claims processing very well, and I can do that for you. Yeah.
Okay, got. And one final question. So, what was the attrition rate this quarter in IT services?
The attrition rate this quarter would have been about 14%.
Okay. So slightly lower than last quarter. Last quarter was, I think, 15%.
Yeah, last quarter there were a lot of, whatever you may want to call it. Yeah.
Right.
Because we are trying to get the right mix of people. Yeah. Both
Okay.
voluntary and involuntary.
Sure. Okay, great. I'll come back in the queue if I have any further questions. Thank you, Srikanth.
Sure.
Thank you, sir. We have next question from the line of Mohit Jain from Anand Rathi. Please go ahead.
Sir, I have two questions. One is on your $1 million clients. Now that number seems to be stagnant for last, I think, 4 or 5 quarters. So what is happening there and how do we plan to accelerate? That's one. And second, in terms of our YOY revenue performance, now that 1 year almost is about to be passed, and we are still 18% down on a YOY basis.
I think you have to understand, we were down on the travel and other things by
Correct. So that's why
if you take that out, I think it was almost like 30 million, right? I mean, if you take that out, we actually shown absolutely net growth kind of stuff.
If I take that out and if I also take Gapbuster out, then it would still be flattish to down on a YOY basis.
Sorry?
If I take the Gapbuster revenues out, it would still be flattish to marginally down on a YOY basis, excluding travel. So my point was, how do we plan to fill this by? When do you think? Now that 3 quarters have passed, and you are
I think
more clarity.
Let me make myself very clearly. What I had said in Q1 of this year is that by Q4 of this year, we'll get back to Q4 of profit of last year, right? Now we have achieved actually our highest. If you take the tax out, our profits are equal to our highest ever this company has ever done, close to. Okay.
Yes.
Our volumes are getting better. So I'm saying to look at volumes, not values, because we have moved on-site to offshore. Okay. So I think you better start looking at profitability and other things too, rather than just a pure top-line number, which can be obtained through a lot of other means kind of stuff. So it's really profitable growth. So we have done about 61 crores, I think, Q4 of last year, and this quarter we have done 75 crores. So
yes.
And we have done. So I think if you look at the growth is going to be profitable growth. So I mean, we're continuing to add top line. As I said, the revenue mix has changed from on-site to offshore. So look at volume growth. Actually, it's much better to do volume rather than value. So look at some other metrics and you'll get the right picture.
Okay. And sir, on the $1 million client?
No, there's no interest of not wanting $1 million clients, but there would be a churn there. Some would have gone and some would have come. So actually, growth we are actually adding. Maybe next time onward we'll report that, so that will be a better indicator.
All right, sir. Thank you.
Yeah.
Thank you. We have a next question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good morning, sir, and thanks a lot for taking the question. Sir, first question is on your international services revenues. So X of travel and X of gangbusters, like the previous questionnaire was also being asked. What kind of growth do we envisage, sir, going forward? And if you can split that into growth coming from newer clients and the growth coming from existing client.
Sorry, I didn't get the question. I mean,
Sir, going forward on your international services revenue.
Yes, I said at the beginning of my call, I said we look forward to achieving similar growth as we go forward, is what I said, right?
Okay. So sir, that is number one. And secondly, on the margin side, you alluded that as economies open up, there will be some costs which will come back. So are we guiding for similar international business margin as earlier with pre-COVID, or do we have some sustainable cost savings or accretion to the margin levels?
One lever was the on-site offshore mix. If it stays this way, obviously there is accretion to the margin, so the margins will get added. So I'm assuming the mix won't change dramatically in the short term. So that should help in the margins being sustained. Then some costs will come back. And some costs which were pre-COVID will not be there, so with some work from home and so on and so forth. So overall, we can look for a little better than pre-COVID margins as we go forward, at least in the near future. Yeah.
Okay, but I think the commentary from a lot of IT companies have been that, because of this pandemic, they have been able to convince, as you were also rightly saying, they've been able to convince that, a lot of work has been done from offshore. But, what is your, given how scenario is, when these things open up, do you think that such kind of a behavior where most of the work is being done from offshore will continue as it is, or it will revert to the pre-COVID sort of a scenario?
That's why I said we will settle something in between is all I'm trying to say. Right now it is, I have no option, so maybe because there's no option, I'd rather do this rather than do anything else. It is working. In some places, it may be still saying there's still some pinpricks, so maybe we'll get back to some in-between model. So, my view on this is it will be somewhere in between. It will not be where it is today and will not be where it was yesterday.
Okay. And on your domestic business gross contribution, which was at an all-time high this time, so are there some one-offs or, is it just because of a higher scale of revenues? Or, are there some one-offs? How we should look at those margins going forward?
As I said, I think we will continue to see growth in that business. Maybe this, quarter, as I said, at 27-28% quarter on quarter is not something to think, but we'll see a steady growth. So it's not a massive aberration. 35 upwards of a 35, where we had an average of I think 31, 32 kind of crores in the past, but we think we can move to an average of about 35 crores gross contribution per quarter. So that's I think what we can look at. So it's so while this quarter specifically could be one time, but the average has gone up from about 31, 32 to about 35.
Understood, sir. Thanks a lot for answering all the questions and all the best for the coming quarters.
Thank you very much.
Thank you, sir. We have next question from the line of Ravi Menon from Motilal Oswal Financial Services. Please go ahead.
Hi, thank you for the opportunity. Srikanth, just wanted to get a sense of, this growth recovery. Good job on recovering so well. And is this coming primarily from new clients, or are you seeing a recovery in the clients who were the worst affected?
So, as I said, the worst affected, some of them have come back a little bit. Okay. We have seen some on the way of coming back. We have there are some I think which are very badly affected, and they're more or less and a lot of other internal structural reasons and all that they're gone kind of thing. So we are seeing I think the quality of client addition this year has been pretty good. So I would think overall if we see the client mix, I think it will be a lot more stable and steady as compared to when we entered the pandemic.
Right. And do you think that we are seeing broader kind of growth, so seeing a broader set of clients participate in the demand versus earlier, you think?
We are definitely now seeing everybody talking about wanting to do stuff. So the number of clients who had earlier said that, we don't want to do anything, we'll wait and watch, etc., are now talking about, let's talk about doing something, and some are actually starting to do something. So there are these two clients, as I said, some for structural and other reasons are gone. So we have got two kinds of clients. One is let's start talking, and the other is let's start doing.
And most of these new clients is Microsoft Dynamics, your tip of the spear?
Yes, a lot of it is Microsoft Dynamics led. Yes. A significant amount, at least 70%. Yes.
All right, great. Thanks. That's all. Thank you, best.
Thank you.
Thank you, sir. A reminder to participants to ask a question, please press star followed by 1. on your touchtone phone now. We have next question from the line of Vinod Makharia from Mohanlal Investments. Please go ahead.
Srikarji, my first question is, my question is, this particular question is specific to the international IT services business. So how does the platformation and the alliance, how does this platformation and alliance-led model play out differently, both in the offshore where all the work happens, and in the marketplace where you actually go to sell your services?
Okay, I'll try to. That's a very good question, Mohanlalji, but yeah, I'll try to answer it in a very short way. So it will take me like a long time to answer this question, but let me. So platformation is the way we go to market with the alliance. So what we are telling the alliance is that Sonata has got this unique proprietary model to do digital transformation. So let's go and offer it to your clients. Instead of just saying, I'll give you Dynamics or I'll give you Azure or I'll give you data, we go and say that, we'll apply platformation and when we deploy these things, you'll get platformation. So that's the go-to-market. And obviously out of that, then whatever services we get rendered is really can be offshore, can be on-site. And we are retooling, as I said, all our services and people to be able to deliver the platformation. So that is the impact we are doing on both the front end and the back end. And how do we, when we commit and promise to somebody saying it's when you do a Dynamics implementation, actually we are helping you with digital transformation and not just doing a package implementation. And this is our method by which you will achieve it. Then how are the people who are engaged in actually delivering it can actually deliver the promise. So that is this implication. So that's the two parts to your question in terms of how do we engage in the marketplace and how do we prepare to deliver to the services we promise.
Okay, yeah, that pretty much, yeah, okay. I get good clarity with that. And sir, my second question is on in the M&A space, which sector or space are you specifically looking at, or what are the spaces you are looking at? What
we are looking at, one is continue to strengthen our Dynamics footprint because we see the established leadership, continue to maintain that. Second is we're looking at Europe as a geography. We haven't done much there. We want to invest there. Third is we are looking at some associated data and cloud kind of stuff. And if you can get it with some other industry verticals, which are in the growth sector, like healthcare or something, but aligned to what some of these, either cloud or data, we are looking at that. Obviously, we are looking at some broad consolidation, global, what are called captive centers in our areas of interest, and so on and so forth.
Okay. And just one comment, this is not a question, that 22 crores of Vivad Se Vishwas and knocking out almost close to 50 crores of contingent liabilities is a very smart move as far as I am concerned.
Thank you very much, G. I mean, that's the way we thought about it. Yeah. Thank you very much for endorsing
Thank you.
that. Yeah.
Thank you, sir. All the best.
Thank you.
Thank you. We have next question from the line of Dheeraj Dave from Samvad Financial Services. Please go ahead.
Sir, I would get to the presentation. Basically, on slide 32, we see actually you are given four good graphs.
I'll ask my finance team to answer that question. Okay, go ahead. Yeah.
Yes. So on bad debts, actually, if we look into from FY13 to FY20, a kind of 7-8 years history, we find this year being the largest with 25 bits being written off. So any specific, like this is a one-time cleanup, why we see this jump? Otherwise, it was like virtually nil in some years, couple of years, and it was very low. So can you throw some light exactly what we wrote down?
I'll ask my finance team to answer that question.
Yeah. Yes. This is not a write-off. So this is a provision made. We had some large deals on this. So on our policy basis, we have made a provision for that because that it was taking a long time for the completion of the implementation of the project, which is they are large organizations. They are not nothing. We are not worried about the recovery of these projects or this receivable. But considering that it is more than 180 days, we have, as per our policy, we have made the provision for it. That's it. Otherwise, it will come back to the normalcy.
Okay, fine. That's the one second question. The second question on slide 22, we see the manpower addition. Okay, now just one part where we find total headcount addition, if I compare Q3 to kind of it, we see that delivery addition has been low. It's kind of approximately 200, but we see kind of major jump into this general and administration. So can you get some idea about like why we are talking about? Slide 23. Number 23. So if you look into the delivery, basically if I take Q3 as a base, Q3 20. Okay, so I find we see reduction into our delivery people or delivery team, but we see addition into general and administration team. So any idea basically why we see also decline in sales and marketing team as well. If I look into Q3 to Q3.
Q3 to Q3 means last year to
Q3 to Q3. Yeah.
Okay. Last year the it is not apple to apple comparison for this, because during this period we have mentioned there has been a change in the mix because people moved differently for different kind of things. But if you see Q2 to Q3, you will see that the all additions, whatever we have around 112 addition, have come only in the delivery. In fact, the sales has gone up also. S&M has also gone up. So the comparable is in the near quarter rather than a last year quarter.
Fair enough. Appreciate. Now, just one more, if I can squeeze. Basically, what is the reason for our since cash flow and everything, even business wise, we are positive. So last year when we declared 5 rupees 50 paisa as interim dividend, what was the reason this time to reduce this to 4 rupees? Can you just throw some light and whether you intend to do some buyback or something, whatever is the management thought?
No, I mean, let me answer the question. So it was based upon a percentage of the profits in the half year. So last year's profit was higher, this year's profit was lower, and we don't estimate a future profit and draw it. So once we finish the year, you'll see what the dividend is. But leave the last year's the final dividend because we did it because of the tax and which was coming because so that's. But we'll go back to the principle of 50% or whatever we have said. We'll go back to that. Yeah.
Should you not look into buyback? In the context of please look into that. Thanks a lot and wish you all the best.
Thank you very much.
Thank you, sir. We have next question from the line of NGN Puranik from Enam Securities. Please go ahead.
Hi, Srikar. Wonderful comeback.
Hi, Puranik.
From almost the precipice you are in. It's a fantastic comeback.
Thank you, Puranik.
Great effort from all your team members. My question is about, see now the digital is what everybody eats, drinks and sleeps today. Getting businesses are moving into digital in a big way, large, medium, small. Where are you on the digital curve in terms of cloud migration to customer experience to analytics? So in that space, where you see a lot of opportunity still in cloud migration, that means you must be mining a lot of new accounts. So if it is more into maturity, you must be doing a lot of customer experience activities. And more enduring work, it will be a lot more analytics, which will last longer than business. The business itself, a huge opportunity there. So where are you positioned yourself in terms of capability, internal capability, in terms of market focus, and your client focus, and the potential $5 to $10 billion account that will accrue out of all this? Some thoughts.
Yeah, I mean, at a high level, I think we have been digital. Like I said, our whole platformation concept is now 4 years old, where we have said we have a very unique way of doing digital transformation by building platforms. We then acquired platforms to support it, built platforms to support it in the industries of choice, which was retail, travel, distribution. We have now done 2 more, which is agribusiness and service industries. So apart from ISP, these are the industries we are focused upon. So our positioning is that domain-led, IP-led transformation. Right now, our significant go-to-market is still based upon the Microsoft Dynamics platform, which because of its nature of being on the cloud, people are using, and their surrounding stuff like Power Platform and Power BI and everything as being treated as a transformational platform change. So we are driving that and then using that to do other things like data and cloud and so on and so forth. So going forward, we are also seeing how we can have the second much stronger direct entry using data and cloud rather than a Dynamics as the digital platform entry. So that's the overall strategy, Puranik. Otherwise, as I said, we have retooled all our people. We've got a concept called the Unified Engineering Program. We are making everybody a full stack engineer. There's a whole lot of internal stuff which is going on to prepare the organization.
So what you are seeing a lot of activity around cloud migration or the complete all the elements of the platform. Is there any elements of platform that is bigger focus and some elements are still growing in the early stage?
That's what I said. So the Dynamics migration is itself a cloud migration because it's a very fundamental shift. You're moving from on-prem to cloud. So we've got a separate program called Modernization of Dynamics customers. There are 10,000 of them in the world who are still on old on-prem stuff. So that's a big push for us, and we have a very strategic relationship there. So we are not just doing like a lot of others who are legacy or data migration onto the cloud. So we are doing fundamental. So that's our stuff, and then using that stack which has been created to build other services.
And the migration tool you have is the homegrown or is it proprietary?
Proprietary. Yeah.
So how does it compare with others in terms of the speed of migration?
It's the best in the world for Dynamics. The number one.
I see. Oh, so how fast it is to migrate process?
It depends on the complexity and number of instances people have and so on and so forth. So we are like the partner, primary assessment partner, where we go and do a consulting first for a client saying that this is, if you do this, what is the benefits, etc. And then we take it on and then there is a technical migration and there's a functional migration. It all depends upon client to client run. It's not something can take 3 years, a big project. Something they say, hey, quickly put me, I don't care. You put any improvement to my functionality and all that, just move me to the cloud. That can be 3 months.
What you're saying that the tool itself has seen significant improvement in its productivity.
Oh, absolutely. The tool itself is 3 years old. Yeah. I mean,
over 3 years, you have seen a lot of improvement in terms of productivity.
Yeah. Because absolutely. There's a huge amount of investment.
So when do you see the data analytics contributing to the?
It's pretty good right now. So I mean, if you see our numbers, I think they are there. So as I said, it's not the primary entry stuff. It is the secondary services, which the second service which goes in after the initial service. So that's pretty good. I think we're quite happy with where we are with our data analytics. But right now we are only focused on the Microsoft stack. So that's why
Microsoft stack. So you have intention to go beyond that, or?
Yeah, we just signed up with Amazon and Google, and then we'll see where that takes. Yeah.
So interesting. Have a great time ahead. Thank you. All the best.
Thank you, Puranik. Thank you.
Bye.
Thank you, sir. We have next question from the line of Harit Shah from KR Choksey Shares and Securities. Please go ahead.
Yeah, thank you. I think you had mentioned something about potential M&A opportunities, especially in terms of maybe acquiring captives of clients. We've seen a lot of your large cap peers do that in the last 2 or 3 months. So are you seeing? Is there any interesting opportunities that are there on the anvil that maybe that could possibly materialize going forward? Because that does.
There's nothing on the board. Nothing we're discussing with anybody. I just said somebody asked what is our interest areas. I said these are the things, and there are a lot of initiatives and searches and so on and so forth. But I can't say that there's anything on the plate. But that's where we are focused. I mean, one of the focus areas. That's what I said.
Right. And secondly, one clarification. So, from this quarter, you've broken up your IMS business into managed cloud and IMS. So, if you could just exactly explain specifically the services you provide in each of these, that would be
IMS
helpful.
are the old services like database on-prem. I mean, so
On-prem,
whatever
right.
IMS services on-prem,
Okay.
server monitoring, server management, database migration, etc. Cloud managed services, the same thing on the cloud. Managing cloud instances, administration, data migration onto the cloud, and so on and so forth.
Right. Okay, great. I just wanted that clarification. Thank you.
Yeah.
Thank you, sir. A reminder to participants to ask a question, please press star followed by 1 on your touchtone phone now. We have a next question from the line of Jay Daniel from Entropy Advisors. Please go ahead.
Yes, sir. You had just mentioned that your migration tool for Dynamics was the best in the market at the moment, and that there are potential 10,000 clients, which is your targeted market. Is there any external validation that that Sonata has been where it is mentioned that?
Yeah, it is. The external validation has been done by Microsoft.
Okay, so Microsoft puts forward Sonata as the best in this particular thing.
Yes, we are the preferred partner for that. I mean, they won't advertise it, but that's what we are.
Any other data points that you can provide to back this up? Because it seems to be quite a material...
It is, but all the 10,000 won't move, Jay.
Okay.
So,
Thank you.
Yeah. I mean, they may stay where they are. They may go to another platform. Yeah. And then some we may not do because they're too small and so on and so forth.
Okay.
Thank you. Anyone who wishes to ask a question may press star 1. As there are no further questions from the participants, I'd now like to hand the conference back to the management for closing comments. Over to you, sir.
Right. Thank you, Vikram. Thank you all, everybody. Thanks for joining. Thanks for your continued support. Thanks for all the good questions. So look forward to your continued interest and support. I look forward to talking to you all soon. Thank you all again.
Thank you very much, sir. Ladies and gentlemen, on behalf of Sonata Software Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect your lines.